All right, welcome back, friends. I am joined today with Kieth Hobart from Peak Mortgage, and we are going to talk about rehab loans and renovation loans, rehab loans, whatever you want
Yeah.
to call them. Specifically, we'll talk a little bit about the 203K FHA loan, but I'd certainly love to hear if you have other programs that you know of or
Totally.
advice. But let's dive into it. How does
Yeah.
a renovation loan work?
Yeah. No, thanks for having me, Joe. So essentially just like it sounds, it's a loan specifically designed for renovations, right? So whether the house it needs a lot of love or just needs a little bit of updating, there are some good loan programs out there to help you be able to get those renovations done to the house without necessarily having the cash, right? So the house you're buying, maybe it needs a little bit of love. You don't have the cash other than for the down payment. This is a great loan, great opportunity to help you get those updates done that you want to do, and through the loan process. So you're not having to do it over the course of time, trying to save up money to do it, whatever it may be. There's some opportunities out there. So
Yeah. And so basically how it works, just an overview is it's like a normal loan, but at the end, once you get the house, you've already got we'll talk a little bit more about the process, but then you're able to basically get the work done and the contractors are paid out of the loan proceeds. Is that
correct.
works?
Yep. I do tell everybody that asks me about these things. It is a lot more work up front. So just right out of the gate, it's a lot of work up front. You're having to make a lot of decisions as far as, hey, what are you wanting to get done to the house? How much is it going to be? There's a lot that goes into this upfront that, unfortunately, if it can take too long or the seller doesn't want to mess with it, it can be a lot of work for nothing. And also, it's hard getting contractors on board with some of this stuff. But if
When they're all busy,
exactly,
anyways.
yeah. But if the situation's right, it can be a good opportunity for somebody to get those improvements done.
Nice. And then standard 203K versus limited 203K. I'll be honest, I had never even. I've worked with so few people using these that I don't even know what the difference is.
Yeah. The big difference in the FHA 203K is just the amount of work to be done, right? So one is going to be just very simple stuff. Usually it's under, I think it's like $30,000 or $35,000 is the limit. So very just kind of basic stuff. And then one's a little bit more extensive. So you're higher dollar amount, doing more stuff to the house other than maybe just cosmetic type stuff. So that's the big difference between the two. And when you're talking with your lender, working with your lender, let them know kind of what things you're wanting to get done, kind of a rough idea of how much you think it's going to be, and then they can kind of help steer you and put you in the correct program.
Makes sense. And I've heard, is the limited one, I've heard of one called a streamlined. Is that kind of the same?
Yeah, exactly. Yep, exactly right.
So another question that comes up a lot is what types of improvements or renovations can be financed with a renovation?
Yeah, so I mean, kind of whatever you can come up with. There's really no limits to it in a sense of how much can be done to it. So typically, you're not going to be doing like major like structural changes. You're not going to be moving walls, things like that. You are working with a contractor. You're also working with a consultant to help guide you along the way on these things. So yeah, I've seen some try to do swimming pools before. I've seen other things try to get done. You are going to be limited to essentially what your house is going to be worth with those improvements. Doing necessarily opening the gates and wanting to do it all is probably not going to be a possibility. But when you're actually doing stuff that adds concrete value to your house and it's going to be worth more money because of those improvements, depending on the condition of the house, it can definitely make sense.
That makes sense. And I guess maybe on that same kind of line of question, when you're doing it, you said, the value, do they take into consideration the new value of the improvements?
Correct. So yeah, we'll just use nice round, easy numbers, right? So let's just say you buy the house for $100,000 and you want to put $20,000 of improvements into it. So you would, basically they're going to appraise that house based off of those improvements.
Got it.
So if you wanted to do a $20,000 solar system, that's only going to increase the value by $5,000. That's not going to work. Now, if you want to do $20,000 put in the kitchen and the bathrooms, all of a sudden the house is now worth $140,000. That makes a lot more sense. So they are going off of future appraised value based off of very detailed criteria of what you plan on doing to the house.
That makes sense. And that's probably why something like a pool doesn't necessarily bring you a ton of value because you don't have a lot of value, especially in Washington.
Right.
And then what are the credit scores, down payment requirements? Anything different there from a typical loan?
Yeah, no, it's going to be the same criteria. FHA is going to be a little bit more generous in terms of minimum credit scores. So you can go a little bit lower going to FHA, and the down payment's going to be 3.5% on that. Conventional is going to be 5%. A little bit higher credit score, but on average, most of those programs are between 580 and 620 is the requirement.
Okay. Pretty generous on that then. And then what's the, I guess, what does the process look like? It's like before, it's kind of convoluted sometimes, or it can feel like it is, or overwhelming. What does it look like? What should people be prepared for if they're looking for this?
So be prepared for a lot of work up front and a lot of work during the process too. So there's a lot of labor pains involved in this. So essentially all the upfront work is finding a contractor. It's got to be a licensed and modern contractor. Can't be your Uncle Jimmy who does things on the side. You're going to be working with a HUD consultant as well. And basically they're a third party there to protect the bank, protect you, protect everybody involved, and make sure that the process is moving along like it should. And everyone's getting paid like they should as things progress. But essentially, you're gonna kind of outline a list of the things that you want to get done to this house, right? And it's gonna be a very detailed list in terms of materials and supplies and all that. And so you kind of put that together with your GC's information as well, and then you send that off. We send that off to get it appraised based off of those improvements, making sure it appraises for what we need it to. And then from there, you're working with the consultant and the GC to get those things done while you're living in the house most times. There are instances we can build in a few mortgage payments if you do need to vacate the house, but I would say 95 to 99% of these you're living in the house during this stuff. And so that'll be another thing is that you're going to be living in a construction site for a few months there while the stuff's being done.
Sounds like these can be a little bit challenging all around.
They can be. Yeah, they're not necessarily the most fun, but they are pretty rewarding once it is done. If you did find a perfect, find a house in the perfect area that maybe just doesn't quite fit your needs like you want it to be done, but it has potential.
Especially one that needs work and has been sitting on the market for months. You might be able to get a deal there.
Yep. One thing we do see is it is hard in this day, because if it is a really, really rundown house or there's a lot of potential there, those are getting gobbled up by investors with cash. And so we see that quite a bit where maybe somebody has their eye on it, but an investor with cash usually speaks a lot louder than somebody trying to do it 2 or 3.
Closing in a week versus 2, 3, 4 months. Yeah,
exactly.
Are there any restrictions on using renovation loans for investments or second homes, and on that note, if there are there any programs out there?
No, it is limited just to your primary residence. So
and then any risks or downsides or anything that somebody should be aware of as they go into it, just kind of high level stuff that.
That's a laundry list as well. So a lot of risks to it, right? I mean, you could pick a bad contractor. You just have a bad experience there. There's a lot of moving parts to these. Your lender will be able to help you navigate these best you can, but at the end of the day, there's a lot of things outside their control too. There's a lot of things outside the agent's control. And so I have occasionally seen these go sideways where it's a bad experience, but hopefully that's where the consultant comes in,
right,
and is able to kind of protect you and all that, making sure things are getting done before they release funds to get paid to contractors.
That makes sense. One kind of follow-on question I have on that: what happens if your estimate for renovating your kitchen is $30,000 and suddenly it's going to be $50,000?
There is a little bit of contingency built in there, but essentially you're going to have to figure out a way to either pay that difference in cash or get it back down to the original quote.
Make sure you're dialed in. The moral of that story.
Yep. Make sure you do all this lifting, this heavy lifting up front in terms of exactly the materials that you want in there, exactly the quantities. And you have a very, very good bid from a contractor.
Cool. Well, I think that's all we have for this episode. I appreciate you joining me and looking forward to having you back.
Yeah, let's do some 203Ks.
Let's do it.
Thanks.